Let's quickly touch on bonds. Um, so long-term bond yields, could you talk about that a bit, JP, and their impact on asset prices, and the potential repatriation of foreign assets, an example of that being Japan?
Yeah. Well, talking about Japan, we saw a stunning election victory by the LDP, Liberal Democratic Party in Japan, fueled by the euphoria for the new prime minister in Japan, Takaichi. And she really is a really forceful personality. It's a very interesting background, and I won't bore everyone with the Takaichi story. But suffice to say that the LDP, the government of Japan, has just secured the largest supermajority. They have more than 2/3 of the members of the lower house in Japan. It's the largest majority of any political party since the Second World War.
Mm.
And she now has a mandate. And basically, Japanese equity markets generally quite like large mandates. We saw it before in previous times. But what that also means is that she has a mandate to kind of pump prime, increase the fiscal stimulus for the Japanese economy. She's actually been very explicit about that. So, for example, it looks like they're going to reduce the sales tax, as an example, and she's trying to bring down prices and inflation in Japan. So what you've seen, of course, in advance of the recent election, which was only last weekend, not the weekend just gone, the weekend before, we saw Japanese government bond yields rising and rising very, very sharply. They've come off a little bit since that time. But in the last 2 to 3 years, Eugene, Japanese government bond yields have gone through the roof.
Yeah.
It is truly remarkable. So I think there's probably still upward pressure on long-term Japanese government bond yields. Here in Australia, we've seen upward pressure on the long end, although in recent weeks it seems to have calmed down just a little bit. So the 10-year today, I'm looking at my screen, the 10-year in Australia today is 4.71. I think that got as high as 4.88 a couple of weeks ago. So there has been some upward pressure on Australian government bond yields. But if you look at a 5-year chart, Australian government bond yields have really pretty much gone sideways over the last 3 or 4 years. 3 years, more than not so much 5 years, 3 years. And then when you look at the United States, now that really fascinates me. You know that I can be as boring as the most boring person on planet Earth. And I've tried to temper my conversation around basis points in my weekly pain report. Some of my favorite subscribers, and I do have favorites, would write to me and say, can you stop going on and on and on about fixed income markets? It's really bloody boring. And so I took their advice. And it was really good timing for me to stop talking about bonds, because actually, if you look at US long dated, and I know you know this, and I'm sure all the listeners will know this, long dated US Treasury government bond yields have done absolutely nothing for like 6, 7, 8, 9, 10, 12 months. They're almost unchanged. And in fact, in recent weeks, the 10-year in the United States we're moving back towards 4%. But we've traded in a relatively narrow range now for a very, very long time. So it's really boring. Yes, bonds are boring again. I hate to say that as someone who started in the bond markets in 1984 in London. And then you've got upward pressure, a bit of upward pressure in the United Kingdom. There's some special factors at work there. We know the Lord Mandelson story and the prospect or possibility that Sir Keir Starmer, the Prime Minister, gets pushed aside by Angela Rayner. We'll see. That's another conversation. But the bottom line is bonds have been relatively dull in much of the world, particularly in the United States, which is probably a good thing.
Yeah.
Whereas in Japan and Australia, there's been an upward bias to them.
Yeah. You want bonds to be dull, I suppose.
Right.
In a sense. And we're going to talk about the portfolios briefly after this, but we've kind of been underweight duration, which has been good because we have seen either a flat line in long-term bond yields or an increase, as we've seen in Australia. But is it, at high fours over for 10 years, is that starting to look a little bit attractive?
Yeah. We haven't really probably touched sufficiently in this conversation today on the massive potential productivity benefits of artificial intelligence. And once you start that exploration or conversation around productivity benefits from artificial intelligence, it takes you immediately into the exploration or the outlook for inflation. And AI, big picture, AI to me is unambiguously a deflationary force. A deflationary force. Now, we're talking over the next 2, 3, 5 years. Now, we don't know how quickly We'll see enterprises adopt and implement and incorporate AI. But I think it's just happening, and it's happening all around me whenever I talk to people.
Yeah.
And that will have long-term productivity benefits and therefore, I believe, be a disinflationary, if not deflationary force. So maybe the long end of the US market, the long end, because the 10s, as I just said, they're trending back towards 4%. It's really interesting. I mean, that conversation I know is taking place in the US about this kind of productivity benefit and dividend from AI. That takes us into that disinflationary impulse. And maybe that's why the long end of the US is moving down a little bit. So it's a hard one to play, but the big picture for me, the big medium-term picture for inflation is one of disinflation, if not deflation. Now, I'm not ready yet to kind of go overboard about my 5-year view being deflationary. I'm not ready. I'm not intellectually ready to jump into that pond. But if you look at China, the deflationary forces are there. And amazingly, Eugene, I never thought these words would come out of my mouth because India's always been a high inflation country. We're getting relatively low inflation in India, which is, I think, very interesting. And I know Japan is having this inflationary experience, but a lot of that is driven by the weakness in their currency. The Japanese yen has been horrendously weak against everything. And a lot of that, because they import a lot of raw materials, they import a lot of energy products, and that is fed through into higher prices in Japan. I think we can almost put Japan on one side for the moment. The big picture, 3 to 5 year view, is there are the disinflationary shocks, I believe, will be greater than the inflationary shocks.
Okay. Well, that'll be interesting to see. And as I think we both agree on, this is all going to change very quickly over time. So, which makes it hard to sort of lock in a yield for 5 or 10 years because you just don't know what it's going to look like.